Good morning, everybody. In this video, I'm going to be sharing with you about assets, the requirements, like I said, of conventional lending specifically for investors and what we all are here to learn about, what we do, what to be prepared for now and down the road. As you continue to evolve and acquire properties, the requirements will change. What assets, like I said, you can use and how they are applied. So let's start, as usual, with some definitions. The types of assets in which we will allow an investor to use for conventional guidelines and qualifications are just simply liquid and non-liquid funds. We'll start with liquid. Obviously, these are your checking, your savings, your money market accounts. Non-liquid are going to be your retirement funds, your self-directed IRAs, your whole life insurance policies, your PERS, your 401ks, all of the above. The ways in which we will apply these assets in underwriting are going to be, we're going to focus on purchase, by the way, for this conversation. There'll be another video about refinance or even the BRRRR strategy that applies to assets, but for this, we're going to focus on purchase. The ways in which they are applied. So your down payment, obviously, and then you've got a reserve requirement, and that's where I'm going to be sharing my screen so you guys can actually see a worksheet straight from Fannie Freddie's seller guide. That is the 1,400-page document of guidelines that apply to qualifying for a conventional loan. And I'll share that with you in a second. So cash to close, let's focus on that. Depending on the property type, you're going to be looking at 15 to 25% to 30% down. These need to be liquid funds. And of the liquid funds, you guys, they need to be what we consider sourced and seasoned. So let me quickly define sourced and seasoned. Sourced means that I need to be able to show it originated with the individual, and the individual has had it for the last 60 days. Okay, that's the seasoned part, 60 days or 2 months worth of bank statements that we have been supplied. And if there is any large deposit in either of the bank statements that you have given us, large deposit is going to be defined as anything over 50% of the individual's income. Example, most of you know that I'm pretty big on examples, so I'm commonly going back and forth and trying to define these things in a more clear, linear version. 50% of the ordinary income. Let's say that you made $10,000 a month, and the bank statements that you supplied us over the last 60 days showed a $5,000 deposit. I'm going to question that. As long as you can give me the paper trail that shows me where that money originated from, maybe you sold a car, maybe you liquidated some stock, whatever the case may be, as long as it came from you originally, that's perfectly fine. Here's an example of something that would not work. Let's say great Aunt Alice said, here you go, Susie, here's $50,000, go invest in real estate, go on vacation, whatever it may be. That's fantastic. Thank you, Aunt Alice. But that would not be considered sourced and seasoned in our definition until that full $50,000 has sat in your account for a full 60 days. I do not want to see that deposit. So depending on your banking cycle, if it's the 1st through the 30th, the 15th through the 15th, whatever it might be, just keep in mind the day in which you make that large deposit, if you can't source it, I don't want to see that month's bank statement. I'll need to see the consecutive 2 months where it's only showing the balance, no longer the deposit, FYI. Okay, down payment. We've already determined it has to be liquid, and those funds have to be sourced and seasoned. One other thing that does count as liquid and sourced and seasoned that's an often question, or a question that I get often rather, is HELOC funds on a property that you own. Those are absolutely liquid, and those are absolutely already considered sourced and seasoned. You don't need to draw from the HELOC and deposit it into a checking account and let it sit there 60 days. We're already good to go, okay? So there's that piece. Let's talk about the reserve requirement, okay? Here's where I'm going to share my screen, you guys. This is a little bit more complicated. I think this is going to be very helpful. How do I share my screen? Okay, hopefully everybody can see this. Again, like I said before, this is straight from the Fannie Freddie Seller's Guide. Okay, this is defined very clearly, very specifically, and what we need to account for to qualify an individual for financing, conventional financing. And you'll kind of notice there's some bullet points here in the middle. The qualifications, if you watch the credit video, the qualifications for reserves actually change as well. As you increase the number of finance properties you have, they raise the qualification bar, and it becomes harder to qualify as you kind of evolve and move up. There was something else I was just going to put in that. There's even a little example here for you guys. Oh, I know what I wanted to share with you. So hold on one second. This particular document is going to be available to you guys, just so that you know. I'll come back to that in a second and tell you how you're going to get that. And before we get into these details, let me just share with you the segue for this. If you want, you guys can click anywhere. I always forget. They tell me where I'm supposed to point, but there's going to be a link on the screen. Feel free to click that and we can talk about, or you'll be able to go back and reference basic qualifications for conventional financing. Will be another video that you can find right there. Okay, let's talk about reserves. So unlike the down payment, right, or your cash to close, which by the way, I don't think I mentioned, you're 20% down or you're 15% down, whatever it ends up being, remember there are closing costs associated with these transactions. So make sure you're accounting for that as well as the percentage down per the property type and the transaction. Okay, reserves. They don't have to just be liquid. Reserve requirements can be in the form of either liquid or non-liquid funds. So we're limited to just the liquid funds over here on the down payment, but the amount of reserves that you have to show on paper, remember, this isn't something you're bringing to the table, obviously. We just need to be able to show that these are your funds for reserve requirements, liquid or non-liquid. One quick tip. We will be asking for, let's just say you're using a non-liquid account to satisfy the reserve requirement. A 401k, okay, is a very, very common one. We will be asking for the terms of withdrawal, okay? And a lot of times people don't realize that within that language from your employer or within your 401k retirement account, that you're only able to have one outstanding loan at a time. If the terms state that, and let's say you had a $100,000 401k in your 401k, but you currently had a loan out of $20,000, a lot of people mistakenly assume that that other $80,000 outstanding or left over would be applicable or available to satisfy the reserve requirement. That is not the case. If the terms of withdrawal say you can only have, or there's only one loan applicable to be out at a time, that would have to be paid off in order for the rest, or for that 401k to be viable to satisfy the reserve requirement. Okay, so just keep in mind the terms of withdrawal will be required when you were using any of those non-liquid assets to satisfy reserves. Okay, so let's talk about this. A lot of you eager beavers have probably already read through some of this. I'm not going to read through all this. Feel free. You'll be able to read that on your own if you want to have access to it. Like I said, I'll tell you at the end how to get that. But let's focus on these bullet points. Again, for anybody that maybe hasn't listened to or watched the credit video, there are 10 golden tickets, as Ridge Lending Group has coined them. The golden tickets we refer to are the Fannie Mae Freddie Mac loans. We call them this because this is the highest leverage at the lowest interest rate literally on the planet that we can access. Of those 10, there are different underwriting criteria that we have to meet to qualify an individual for investment financing. In this case, there's three buckets. There's three buckets. there's three buckets that we have to be prepared to satisfy. The first one is going to be for individuals that are going to be within the 1 through 4 finance properties. The second one will be for 5 and 6, and then there's a third bucket and set of underwriting guidelines as applied to assets, specifically reserves, that will be 7, 8, 9, and 10. Okay, real quick, and it says this within the context of this page, but if you're just focusing on me, the primary residence where you're going to live, although it will not count as part of the actual formula or calculation, the dollar amount of reserves that you have to show or satisfy, it will count as the number of finance properties. Okay, example, let's say that you are purchasing your third property, or no, let's say you're purchasing your fourth property. Okay, you may think that you're in the 1 through 4, right? Because it's just 4 rental properties. However, that would be incorrect. Your primary residence will count as 1, 2, 3, 4, and then you're purchasing your fourth here. Then you would be in the 5th and 6th, if that makes sense. Anyway, just keep that in mind, okay? So, whoops. So, bucket number 1, loan spots 1 through 4. If you can see here, right in the middle of the page, here's our visual aid. 2% of the aggregate UPB, that stands for unpaid principal balance, if the borrower has 1 to 4 finance properties, okay? I'm going to use round numbers as our examples in this. So let's say that the example, and I'll take it all the way up to the 10th finance property, our investment properties will all have outstanding unpaid principal balances of $100,000 each. And our subject property, that'll make sense in a second, will have a PITI. What's PITI? Anybody? Principal, interest, taxes, and insurance will have $1,000 a month for the subject property. Okay, so we're purchasing property number 3. Okay, that keeps us in the first bullet, and we have a primary residence. If you were a renter, then that would be a different conversation. But you have a primary residence, and you're purchasing property number 3. That is considered our subject property. Okay, so stay with me here. You've got your primary residence, you've got rental property 1, you've got rental property 2, rental property 3 is our subject property. Okay, although we have to count the primary, it's not going to be part of the following formula. What we need to do is we need to take properties 2 and 3, 100,000 each. Remember, we're going to add those together. That's 200,000 times 2% of the unpaid principal balance. Okay, I can't do mental math, but I think I can figure this one out. 2% on 200,000, there's $4,000 of reserves that we need to show in that example. Plus, if you'll notice right down here, there's a little asterisk. Subject property requires 6 months of PITI for reserves, in addition to. So we've already determined that our subject is going to be $1,000 a month times 6 months. There's $6,000, $4,000, and $6,000. $10,000 would be the reserve requirement that we would have to meet in that example. Okay, let's move on. So we're now in 5 and 6 finance properties. I'm not going to keep going back through the primary and the 1, 2, 3, 4, 5. Okay, but you can see that 5 and 6, they up that qualification bar. Instead of 2% on the outstanding principal balance, we now have to show 6% of the, I'm sorry, forgive me, 4%. I skipped one. 4% of the outstanding unpaid principal balance. So we're purchasing property number 6. Okay, we've got 6 times 1,000 is $6,000. There's our subject property reserves. Then we've got the remaining 4, right, rental properties at 100,000 a piece. Everybody still with me? We've got 400,000. Everybody still there? 4 times 4, and then you add the $6,000. What is that? Oh my God. Is this happening right now? 4,000, 4%, 400,000 plus the 6. Hold on, everybody. I told you I couldn't do mental math. 22,000. I'm in finance. Yeah, I've been doing this a while. 22,000 is where we would be in property number 6. Watch, I'll have done that wrong. That'll be super funny. Okay, last but not least, let's get through this. 6% is where we go next in the 7 through 10. Let's just assume we're purchasing number 10, property number 10. We've got $6,000 for our subject property right there. Properties 2 through 9, there's $800,000 of unpaid principal balance. What's the math there? Somebody smarter than me. So plus 6,000, we've got $54,000 of reserves is what we need to account for when we get to property number 10 using the variables or the example pieces that I've got here. $100,000 on the unpaid principal balance per property, and then our subject property was always at $1,000 a month. And that's it. That's how it goes. The other things that I wanted to comment here, keep in mind, unless you're going to be super aggressive with your acquisition, right? If you're going to be purchasing super quickly, and maybe your 401k isn't quite there, you've got enough for the down payments and things, you may not be able to accelerate as fast as you would have wanted to. But remember, as you continue to amass these properties, you acquire these properties, chances are the monthly passive income that you'll be gaining, $200, $300, $400, $500 a month, right? Unless you're going to be using that or deploying that for living expenses, what's going to happen with that money? You're probably going to be stockpiling it. Those funds obviously will be used or could be used if you needed for the reserve requirement over time. And that's going to continue to build up and snowball, etc. Okay, so, and then here's, if you guys see, this is kind of an example that we just went over. This will be helpful. I don't know that I mentioned unpaid principal balance on a second home. Should that be applicable? That actually would count. right? Your primary residence won't, but a second home and investment properties will. Okay, so before we get into the next video, I want to just kind of ask you guys a favor. Please, if you would, let's comment on, when we talk about assets, what I'm interested to know and maybe share with the rest of us is maybe a story, a win, or even a horror story as it applies to private money lenders maybe that you've worked with, that will give us an idea of where, you know, what we want to be prepared for, what you guys have found out there, good, bad, indifferent, etc. Please feel free to leave those comments for us, okay? Special thank you, like I said, please go ahead and click on the link in the pinned comment at the top of the comments section. I think I'm pointing in the right place. In doing that, there'll be an intake. Just give us your email address and I will send you guys all this exact spreadsheet to use if you'd like, or not spreadsheet, this cheat sheet, Word document. It's there for you. Let's get rid of that. If you go ahead and do that for us, let's go back here. There we go. So please, yes, go ahead and leave a comment. I will get you guys over that, the conventional guideline matrix as we just reviewed together. Next up, DTI. So I would tell you that this is going to be the most important part of these three basic qualifications. If you've watched credit, this is now asset. Next is going to be debt to income ratio. I would suggest you guys have a good breakfast that day if you're going to be watching that. It's quite intensive. It goes down a few rabbit holes, so just be ready for that. Anyway, okay, so DTI, what am I supposed to tell you? You want to click here or here or here to watch that next video. I look forward to seeing you all. Have a great day, and we'll talk again soon. Bye.